Welcome to the Pro Ticker Deep Dive.
Good to be here.
So today is Friday, February 27th, 2026. And I have to be honest with you, looking at everything going on today, I feel like I need a stiff drink. Or maybe just a nap in a soundproof room.
Yeah, it's a heavy day. Heavy and, frankly, a little disorienting if you look at the board.
Disorienting is the perfect word for it. Because if you look at the headlines right now, or if you look at the raw data, we are living through a moment of just absolute head-spinning contradiction.
Right.
It feels like the financial world has split into two parallel realities that are somehow trying to exist in the exact same space.
We often call that market dissonance. It's when the signals stop correlating in the ways we were all taught in school, and they start actively fighting each other.
That is exactly what it feels like, because on one hand, I'm looking at my mail and I know there is a massive government stimulus check coming. The tax refunds, regular people are about to get a serious cash injection. And the real economy numbers, like GDP, they actually look okay.
On paper, sure, the patient looks healthy.
But then I turn on the news or I look at the trading screens and it's a horror show. We have kinetic war looming in the Middle East. We have this chaotic, totally unpredictable legal battle over trade tariffs that is just freaking out every CEO in the country. And then, and this is the one I really want to dig into deep today, there's this sudden, very dark shift in how investors are talking about artificial intelligence.
Oh, the vibe has definitely shifted there. We've gone from AI is a miracle that will save us all to AI is a threat that might bankrupt us practically overnight.
And all of this confusion has basically culminated in one massive blinking red light in the data, the 10-year Treasury yield.
The benchmark.
Yeah.
Literally the most important number in global finance.
It has crashed. It broke right through that psychological 4% barrier. I'm seeing it settle around 3.98 or 3.9% this morning. That's a 4-month low. And this is the hook. This is the thing I just cannot wrap my head around. Why are yields falling?
Why does that surprise you, though?
Well, usually yields drop when investors expect a recession, right? Or when they expect inflation to completely disappear. But inflation isn't disappearing. It's super sticky at 3%. And the government is pumping cash into the economy. So if inflation is eating your money at 3% a year, why on earth would you lock your money away for 10 years at less than 4%? The math just doesn't work. You are basically guaranteed to lose purchasing power.
You're looking at it like a rational investor who is seeking a return on capital. But that is not what is happening right now. What we are witnessing today is what I'm calling the great recalibration.
Recalibration of what exactly?
Of risk.
Yeah.
The market is currently caught between the real economy, which looks fine on paper, people are spending, restaurants are full, and the fear economy.
The fear economy?
Yes. The fear economy is being driven by three massive headwinds right now. You've got AI displacement anxiety, kinetic war risk in the Middle East, and trade war chaos. Investors aren't buying that 10-year bond because they love the 3.98% return. They know they're losing to inflation.
Yeah.
They're buying it because they are utterly terrified to put their money anywhere else.
So it's a bunker.
It is a financial bunker. It's a flight to safety in its purest, most raw form. When the air raid sirens go off, you don't ask how comfortable the bunker is, you just get in.
Okay, I want to take this apart piece by piece. Because if the bond market is scared, and the bond market is usually the smart money in the room, then the rest of us should be paying very close attention. So let's start with the bond market anomaly itself.
Let's do it.
You mentioned the 10 years down. We're talking roughly a 25 basis point drop just in February. But looking at the broader curve, the 30-year bond is also down, sitting around 4.70%. But the short-term rates, like the 2-year, they aren't moving nearly as much.
Right. This is what bond traders call a bull steepening of the yield curve.
Okay, let's pause right there. Bull steepening. Break that down for the listener who isn't trading fixed income every single day. Why does the actual shape of the curve matter?
So imagine a seesaw. On one end, you have short-term rates. That's the end the Fed basically controls. That end is currently stuck high up in the air because the Fed hasn't cut rates yet. On the other end of the seesaw, you have long-term rates. That's the end the market controls based on their collective view of the future. Right now, the market is pushing that long end down hard.
Because they think the future is going to be materially worse than the present.
Exactly. When the curve steepens this way, with long rates falling faster than short rates, it's the market screaming, "We do not believe this current stability is going to last." They are betting that eventually something big is going to break, and the Fed will be forced to slash short-term rates dramatically to save the system.
They're front-running the Fed.
They are completely front-running recession. They are locking in whatever yield they can get now because they think rates are going to zero eventually.
But again, I have to play devil's advocate here. Inflation is sticky at 3%. If I lend the U.S. government money at 3.9% and inflation is eating 3%, my real return is nothing. It's less than 1% before taxes.
It's practically zero. In some high tax brackets, it is literally negative.
So why do it? Why not buy an S&P index fund? Why not buy real estate?
Because zero is better than minus 50.
Ah.
Yeah. If you genuinely believe the stock market is about to crash because of a war or because the tech bubble is bursting, zero suddenly looks like a winning lottery ticket. It becomes about return of capital, not return on capital. And this brings us to this concept of the new neutral.
Yes, I've seen that phrase floating around, new neutral. It sounds like a really bad indie band.
It really does, but it's actually a critical economic concept. Economists and traders have been debating for the last 2 years where the 10-year yield should naturally settle in a healthy, balanced post-pandemic economy, and the consensus over the last year has been hovering right around 4.2%. That's supposed to be the equilibrium where growth and inflation are perfectly balanced.
And we are below that now. We are under 4.
We are significantly below that. Dropping below 4% is a massive signal that the market thinks the neutral state is gone. They are pricing in a calamity. They are deviating from that equilibrium because they smell danger. They are effectively saying, the world is about to get much colder, so I am putting on a heavy coat, even if the thermometer right now says it's perfectly sunny outside.
Which leads us perfectly into the next big piece of this puzzle, because one of the reasons they think the world is about to get colder is coming from a place that, until very recently, was supposed to be our ultimate savior. We need to talk about the AI fear trade.
This is, in my professional opinion, the most fascinating psychological pivot we have seen in the markets in the last decade.
It really is. I mean, think back to 2024, 2025, even just 6 months ago. AI was the magic money printer.
Absolutely.
You bought NVIDIA, you bought Microsoft, you bought any startup with intelligence in the name, and you made money. The overarching narrative was this massive productivity boom.
Correct. The story was so simple and so seductive. AI makes workers faster. Companies make more profit because of efficiency. GDP goes up. Everyone wins. It was supposed to be the Roaring '20s 2.0.
But looking at the tech sector this month, they are getting hammered. And the narrative seems to have completely flipped from productivity to displacement.
We have moved from the productivity phase to the displacement phase in the collective mindset of the market. And this is crucial to understand because it changes the economic logic entirely.
Meaning job losses.
Meaning white-collar obsolescence.
Makes sense.
The bond market is starting to price in a deeply deflationary future. See, inflation comes from people having money and actively spending it. It comes from too much money chasing too few goods. But if you have a massive chunk of the white-collar workforce, we're talking coders, accountants, middle managers, graphic designers, if they suddenly start fearing for their jobs,
They stop spending.
they completely stop spending. They don't buy new cars. They don't upgrade their homes. They cancel the Disney vacation. They hoard cash. That creates a massive demand shock across the economy. And a demand shock is inherently deflationary. Prices fall because literally no one is buying.
And what is the traditional central bank cure for deflation?
Lower interest rates.
So investors are buying bonds right now, locking in those 3.9% yields because they think AI is going to force the Fed to cut rates back to zero just to save the economy from a complete labor collapse.
Precisely. It's the productivity boom, violently morphing into a labor bust.
That is a terrifying phrase, labor bust.
It is. High productivity is fantastic for corporate margins in a vacuum. Companies can make more stuff with fewer people. But if that results in a labor bust, the macroeconomy suffers because no one actually has the disposable income to buy the stuff the companies are making. It's a classic Henry Ford problem. If you don't pay your workers enough, who's going to buy the cars?
But let's ground this for a second. Is this actually happening right now? Or are investors just sitting in dark rooms telling themselves ghost stories? Because I haven't seen mass layoffs dominating the headlines this month. The unemployment rate isn't spiking up to 6 or 7% yet.
It's not about mass layoffs yet. That is a lagging indicator. What we are seeing right now, in real time, is the freeze. We are seeing a low-hire, low-fire dynamic take hold across corporate America.
Low hire, low fire. Explain how that works in practice.
Companies aren't firing everyone yet because they honestly aren't sure if the AI agents are fully ready to take over complex workflows. They don't want to gut their human staff and then find out the new software hallucinates half the time. But they definitely aren't hiring new humans either. Job openings are evaporating. Corporate America is in a very tense holding pattern. They're just waiting to see if they can replace their natural attrition with software instead of new hires.
That feels almost worse than layoffs in a way. It's like a slow suffocation of the labor market.
It creates a completely stagnant labor pool. And crucially, it kills wage leverage. If you have a job right now, you are terrified to march into your boss's office and ask for a raise because you know a software bot is breathing down your neck. And if you don't have a job, you can't find one because all the entry-level and mid-level roles have vanished from the job boards. That suppresses wage inflation. And that is exactly why the bond yields are crashing. The market is betting that the robots win and the human workers lose their purchasing power.
That is incredibly bleak. But it perfectly explains the violent rotation out of tech stocks we've seen. If you think the AI revolution ends with a consumer demand collapse, you definitely do not want to own the companies selling the AI.
Exactly. Why own the shovel seller if the gold miners are all going broke? It's the AI fear trade, and it is dragging everything else down with it.
Okay, so we have this slow-motion structural threat of AI deflation. But we also have a very fast-moving, very kinetic threat happening at the exact same time. Geopolitics.
This is the immediate catalyst. If AI is climate change, slow, structural, inevitable, this geopolitical situation is a Category 5 hurricane making landfall right this second.
We are talking about the Middle East, specifically the nuclear talks in Geneva involving the U.S. and Iran.
Which just concluded yesterday, Thursday, February 26th.
And the result of those talks was nothing.
Worse than nothing. It was a completely hostile breakdown. The diplomatic language used by both sides afterward was icy, to put it mildly.
What actually happened in the room over there?
The U.S. delegation came to the table with maximalist demands. They didn't just ask for a temporary pause on enrichment. They flat out told Iran to dismantle specific highly fortified sites. Fordo, Natanz, Esfahan, these are the absolute crown jewels of the Iranian nuclear program. Fordo is literally buried deep inside a mountain to protect it from bunker buster bombs.
So the U.S. is basically asking them to surrender their national sovereignty on this issue.
Pretty much. And Iran flat out said no. They countered by demanding immediate sweeping sanctions relief before they would even touch a single screwdriver at those facilities. Neither side blinked. The U.S. delegation basically packed up their briefcases and walked out.
And while they were arguing in some fancy conference room in Switzerland, what was happening on the water down in the Gulf?
The U.S. has quietly assembled the largest naval and air armada in the region in 20 years. The USS Abraham Lincoln Carrier Strike Group is there, along with a massive support fleet, destroyers, cruisers, logistics vessels. It is a full-blown war footing.
And in response to that buildup, Iran has once again threatened to close the Strait of Hormuz.
I feel like we hear that specific threat a lot, though. We'll close the strait. Every time tensions rise, they pull that card. Does the market actually take it seriously this time around?
Look at the price of gold today.
I saw that. It blew right past $5,000 an ounce.
You do not get $5,000 gold because people are mildly worried about a little consumer inflation or minor currency fluctuation. You get $5,000 gold when people are terrified of event risk.
Define event risk for us in this context.
An event risk is a singular, catastrophic, binary occurrence that breaks the global system overnight. A preemptive missile strike on a nuclear facility, a physical blockade of a major shipping lane, a dirty bomb, a formal declaration of war. Gold is the ultimate historical hedge against pure chaos. When it spikes violently like this, it is the collective market screaming that the probability of a kinetic war, actual shooting, actual bombing, is higher than it has been in decades.
So the bond market is pricing in a structural, AI-driven recession, and the gold market is simultaneously pricing in World War III.
Precisely. And the terrifying part is how they reinforce each other. Think about the mechanics. If a war actually breaks out, oil prices instantly spike, which crushes the global economy. But simultaneously, geopolitical uncertainty explodes. When uncertainty explodes, institutional investors dump risk assets like stocks and hoard safe haven assets like treasuries.
It really is a perfect storm of fear. You have the long-term technological fear and the short-term military fear converging in the exact same week.
And just to sprinkle a little more chaos on top of that lovely Sunday, let's talk about the domestic situation, because apparently we don't just have military conflict abroad, we have severe economic conflict right here at home.
Yes. The trade war saga. This has been a legal and regulatory roller coaster that makes law and order look completely boring.
It has been incredibly confusing to follow for anyone not deep in the weeds. Let's map it out for the listeners because this directly affects the supply chain of basically every business in the country. The Supreme Court recently struck down the administration's initial wave of tariffs, right?
Correct. The administration initially tried to impose broad reciprocal tariffs. The basic logic was, if you tax our goods at 20%, we tax your goods at 20%. The Supreme Court stepped in and essentially said, no, Mr. President, you do not have the constitutional authority to unilaterally do that without an act of Congress. That is legislating, not executing.
And for a brief, fleeting moment, the global markets cheered. Equities popped. Everyone thought, ding dong, the trade war is dead. Free trade is back on the menu.
But it wasn't dead. It was just changing shape. It was mutating into something much more complicated.
Enter Section 122.
Right. This is the critical pivot. When the Supreme Court blocked the reciprocal tariffs, the White House didn't just throw their hands up and give up. They had their lawyers dig deep into the legislative archives, and they dusted off Section 122 of the Trade Act of 1974.
Section 122, it sounds like a secret protocol from a Cold War spy novel.
It is an incredibly obscure provision that was originally designed for severe balance of payments crises. It essentially allows the president to unilaterally declare a national economic emergency if the U.S. trade deficit is so catastrophically high that it threatens national security.
So they basically found a 40-year-old legal loophole to do the exact same thing the Supreme Court just explicitly told them they couldn't do.
Effectively, yes. Over the weekend, on Saturday, they announced a sweeping 15% across-the-board tariffs utilizing this emergency authority.
Now, let me play the devil's advocate again here. Why does this specific legal authority actually matter to the market? A tariff is a tariff, right? Whether it comes from a clean bill in Congress or a murky emergency order, the tax on the imported widget is still 15%.
It matters entirely because of uncertainty. If it is a legislative tariff cleanly passed by Congress, it becomes the law of the land. Businesses can model it. They can plan their supply chains around it. They can adjust their retail pricing models. But if it is an emergency order based on a highly contested interpretation of an obscure 1974 law, that means we are operating in a complete legal gray zone.
It means endless lawsuits.
It means years of litigation. It means the 15% rate could arbitrarily change to 25% tomorrow based on a new executive whim. It means a lower court could issue an injunction and strike it down again next Tuesday. It means a business owner who is trying to import steel or microchips has absolutely no idea what their actual landed costs will be in 30 days.
And if there is one thing capital markets and corporate boards hate more than bad news, it is uncertainty.
Exactly. You cannot confidently invest in a multi-year supply chain infrastructure if you literally do not know what the rules of the game will be next month. We are seeing a phenomenon right now that international portfolio managers are calling the Sell America trade. They are aggressively dumping U.S. equities, not necessarily because they hate American companies, but because the domestic regulatory environment has simply become too erratic to underwrite.
We even saw the South Korean trade minister out on the wires expressing extreme anxiety over the weekend. When normally stoic diplomats start throwing around phrases like extreme anxiety, you know the situation is rapidly deteriorating.
Right. So international capital flees U.S. stocks because of the trade chaos. And where does all that terrified capital go?
Right, back into bonds, back into the bunker.
You see the self-reinforcing pattern here. Every single piece of bad macro news we've discussed inevitably leads right back to the exact same trade. Buy U.S. treasuries, buy physical gold, and hide under the desk.
Okay, so we have war risk, we have trade war chaos, and we have the slow burn AI fear. And all of these disparate roads ultimately lead to one building in Washington, the Federal Reserve. Let's look at what they are facing.
The Fed is in a terrible position right now. Possibly the most complex and dangerous position they have navigated since the volatile days of the late 1970s.
The current Fed funds rate is sitting at a target range of 3.50 to 3.75%. They officially paused their cutting cycle in January. But looking at the commentary this week, Fed Governor Christopher Waller bluntly called the upcoming March 18th policy decision a coin flip.
A coin flip. That is incredibly candid, almost dangerous language coming from a sitting Fed governor. Usually the Fed communicates through highly choreographed forward guidance. They go out of their way to telegraph their moves weeks in advance so nobody panics. For a governor to publicly admit it's a coin flip means they genuinely, institutionally do not know what the right move is.
Why is it so hard, though? It seems obvious to me on the surface. If the global economy is facing all of these severe cascading threats, kinetic war, massive supply chain disruption from tariffs, AI-driven job deflation, just cut the rates,
Yeah.
right? Provide liquidity and stimulate the economy.
If only central banking were that simple. Here is the inescapable trap they're caught in. The argument for cutting rates is obvious, as you said. You have the AI fear trade freezing hiring. You have slowing baseline economic growth. GDP was only 1.4% last quarter. And you have this massive geopolitical shock looming. But the argument for holding rates steady is inflation.
The sticky 3%.
Right. The headline inflation number is stubbornly stuck at 3%. The Fed's mandated target is 2%. And more specifically, services inflation, things like haircuts, auto insurance, medical care, rents, elbow, those are still actively rising. If the Fed panics and cuts rates aggressively to fight the fear in the markets, they risk pouring high-octane gasoline directly onto that underlying inflation fire.
So they basically have to choose between deliberately causing a recession by keeping rates too high for too long, or accidentally causing an inflation spike by cutting prematurely.
Exactly. They are completely damned if they do and absolutely damned if they don't. And amidst this impossible, highly technical economic choice, you have an explosive political war raging in the background.
The White House pressure campaign?
The administration is absolutely furious with the Fed. They are publicly attacking the committee on a daily basis, demanding aggressive cuts down to 1%. They desperately need cheap money to offset the massive economic pain those new tariffs are going to cause for consumers.
And we can't ignore the recent nomination of Kevin Warsh as the next Fed chair. What does Warsh represent in this incredibly complicated equation?
He is a fascinating wild card in all of this. He generally leans somewhat dovish on the actual Fed funds rate, meaning he favors lower interest rates, which aligns with what the White House is demanding. But, and this is a huge but, he is a massive hawk when it comes to the central bank's balance sheet. He strongly dislikes the Fed buying bonds to prop up the market, a practice known as quantitative easing.
So we might be looking at a bizarre scenario where he slashes the headline interest rate to appease the politicians, but simultaneously stops the actual money printing machine in the background.
Yes, and that is a deeply mixed signal that the bond market has absolutely no idea how to price in right now. Lower rates usually mean easier financial conditions, but a shrinking Fed balance sheet means tighter financial conditions. It's contradictory.
It sounds like the pilot and the co-pilot are having a fistfight over the yoke while the plane is actively flying through a Category 5 hurricane.
That is a deeply disturbing but highly accurate analogy for current monetary policy.
Well, let's try to find a parachute in this plane somewhere. Is there any good news at all out there? Because looking at the data, it seems like there might be a massive fiscal tailwind hitting right now. The sugar high.
Yes, finally. Something unambiguously positive for the listener's actual wallet. We can stop talking about macroeconomic doom for at least a few minutes.
We are talking about the rollout of the OBBA, the One Big Beautiful Bill Act,
Right.
which I just have to say is a terrible name. Whoever drafted that acronym needs to be sent back to marketing class immediately.
It's a remarkably terrible name, but it has a highly significant real-world impact. The legislation was actually passed back in July of 2025, but because of the quirky way the federal fiscal year works, the massive retroactive tax cuts embedded in the bill are only hitting bank accounts right now.
Because we are right in the thick of tax season, people are actively filing their 2025 returns as we speak. What are they actually seeing when they hit submit on TurboTax?
They were seeing absolutely huge refunds. The early Treasury data suggests that average tax refunds are up roughly 20% year over year. The average direct deposit hitting American bank accounts right now is coming in at around $3,500.
$3,500 is not pocket change. That is a highly material liquidity injection for a standard household. For a middle-class family of 4, especially if both parents are working hourly jobs, that could be life-changing money in the short term.
It's massive. And the brilliance, or perhaps the political calculation of the bill, is that it is targeted in very specific, highly visible ways. For instance, the bill entirely eliminates the federal income tax on tipped wages.
That is a tectonic shift for the service industry. Bartenders, waiters, hospitality staff.
Completely changes their take-home pay calculus. Furthermore, it eliminates the federal tax on all overtime pay.
Wait, let's stop and unpack that one because that is wild. Overtime pay? So if I am an hourly worker and I grind out my standard 40 hours, I pay my normal marginal tax rate. But if I work 50 hours, that extra 10 hours of time and a half is completely tax-free at the federal level.
Federal tax-free, yes. You still pay state taxes where applicable, but the federal burden is gone. That is a massive, immediate behavioral incentive for the hourly workforce to grind as hard as possible. It basically boosts your effective hourly rate for any overtime work by 20 to 30% instantly.
And I'm seeing another bullet point here in the summary: deductibility of auto loan interest.
That's a brand new one. We haven't had tax deductibility for standard consumer debt like that in a very long time. With average new car prices remaining incredibly high, allowing regular people to deduct the interest on their car note is a direct, targeted subsidy to the middle class. Plus, for the higher earners, the state and local tax deduction was raised significantly, from $10,000 up to $40,000.
Which instantly saves the upper middle class in high-tax states like New York, New Jersey, and California an absolute fortune. So let's add this all up. We have billions of dollars of cash directly hitting American bank accounts right now. February, March, April. Shouldn't that massive influx of capital ignite an economic boom? Shouldn't we be seeing a retail spending spree that crushes any talk of a recession?
This brings us to the ultimate tug-of-war defining the 2026 economy. You have the fear economy pulling back hard, terrified about losing their jobs to AI and terrified about a war in the Middle East, and you have the fiscal sugar high desperately pushing forward with free cash.
Who wins that tug-of-war?
It entirely depends on mass consumer psychology. It is the classic economic battle between the marginal propensity to consume and the marginal propensity to save. If I hand you a check for $3,500 today, but you are privately terrified that an AI agent is going to make your specific job redundant by next Christmas, what do you actually do with that money?
I don't spend it. I put it straight into a high-yield savings account as an emergency fund. Or I use it to aggressively pay down my high-interest credit card debt.
Exactly. And if you save it, or if you use it to deleverage your personal balance sheet, that money does not boost GDP. It does not go to a restaurant. It does not buy a new television. It does not create consumer inflation. It just sits there statically. This is exactly why these massive tax cuts might completely fail to save us from an economic slowdown. If the baseline fear is strong enough, the stimulus money gets hoarded, not circulated. It strengthens the individual consumer's balance sheet, which is good, but it utterly fails to stimulate the broader macroeconomy.
That brings us to the one sector where people usually feel comfortable spending massive amounts of money or taking on massive amounts of debt. Let's talk about housing.
This is actually the one area where the catastrophic bond yield crash directly helps regular people on Main Street.
Because mortgage rates closely track the 10-year Treasury yield. So if the 10-year yield is crashing below 4%,
Mortgage rates are crashing right alongside it. The standard 30-year fixed mortgage has officially dropped to 5.98% this week. We are finally officially back in the fives.
that is a massive psychological barrier being broken. Seeing a 5 in front of your mortgage quote feels fundamentally different than seeing a 7.
It really is night and day for affordability models. Real estate economists across the board are predicting an absolute barn burner of a spring buying season. They think frustrated buyers who've been sitting on the sidelines for 2 years are going to flood back into the market now that rates are somewhat normalized.
But I keep hearing industry people talk about the lock-in effect. Isn't that still a massive bottleneck?
That is the immovable object in this scenario. Yes, current rates are 5.98%, which looks fantastic compared to the peak of last year. The vast majority of current homeowners, maybe you, maybe most of our listeners, are sitting comfortably on 3% or even 2-point-something% mortgages that they locked in during 2020 or 2021. They simply cannot afford or rationally justify selling. Why would you ever trade a 3% 30-year liability for a 6% liability just to move across town?
So we might be sleepwalking into a situation where buyer demand absolutely skyrockets because of the sub 6% rates and the tax refund cash injections, but housing supply remains completely frozen.
Exactly. We are going to have an army of highly motivated buyers armed with fresh stimulus cash, chasing a historically depleted inventory of available homes. Which means only one thing happens to housing prices.
They explode upwards again. Bidding wars return.
Exactly. Which means absolute affordability doesn't actually improve for the first-time buyer, even though the headline interest rate is lower. It is a deeply cruel irony of the current market mechanics.
And all of this, the unaffordable houses, the looming threat of job loss, the geopolitical anxiety, it all feeds directly into this cultural phenomenon we keep seeing. The vibe session.
The vibe session, I love that term. It is the only word that accurately captures the zeitgeist of 2026.
It really does.
Because objectively, we have the cash. The tax refunds prove it. We still have the jobs, at least for now, before the AI rollout reaches scale. But the vibes are just rancid.
People fundamentally feel unsafe. You cannot genuinely enjoy a $3,500 tax refund when you are doom scrolling through news about nuclear talks collapsing in Geneva and reading think pieces about how software is going to replace your accounting department. The economic wealth effect isn't just about the raw numbers in your checking account. It is heavily dependent on future confidence. And right now, consumer confidence is shattering into a million pieces.
And historically speaking, when consumer confidence violently shatters, the actual economy usually follows shortly behind it.
So let's try to pull all of these disparate threads together. We have covered the strange bond market anomaly. We dug into the deflationary AI fear trade. We looked at the kinetic war risk in the Gulf and the regulatory trade chaos at home. We analyzed the Fed's impossible dilemma, and we looked at the massive tax refund sugar high fighting against it all. It is a truly dizzying landscape to navigate.
It is a profound transition period. The old rules of thumb that governed the last 40 years of finance are actively breaking down in real time.
If you had to distill the core mechanism driving everything right now, is it accurate to say that fear is actually lowering our systemic cost of borrowing?
That is the ultimate paradox of the 2026 market. Bad news creates profound fear. That fear drives institutional investors to indiscriminately hoard safe haven bonds. That massive buying pressure on bonds causes their yields to rally downwards, which lowers interest rates across the entire economy. So perversely, the worse the world looks geopolitically and technologically, the cheaper money gets. The underlying fear might actually be the only structural force keeping the global economy liquid right now. It is a deeply perverse safety mechanism.
That is a remarkably twisted, almost cynical way to look at how our financial plumbing works.
It's not cynical, it's just the mechanical reality of where we are today. Good news is bad news, and terror is liquidity.
Well, before we sign off, I want to leave you, the listener, with one final thought to chew on. Something that hit me like a ton of bricks while we were discussing those overtime tax cuts earlier.
Go for it. Let's hear it.
We, as a society, are currently spending hundreds of billions of dollars on this OBBA fiscal stimulus. We are actively using the tax code to incentivize overtime labor. We are implicitly telling the working class, work harder, work longer hours, and we won't tax that extra effort.
Right. That is the explicit policy goal. Maximize human labor output.
But if the AI fear trade that the bond market is pricing in is actually correct, if the smart money knows something we don't, and a massive swath of white-collar and even some blue-collar work is about to be rapidly automated away by software,
then we are aggressively incentivizing and subsidizing a human behavior that is about to become economically obsolete.
Exactly. Does a generous tax cut on human overtime pay even matter in a meaningful way if there is simply no overtime work available to be had? Are we utilizing a blunt, 20th century tax policy which is entirely focused on maximizing physical labor hours to try and fix a 21st century crisis of technological displacement?
That is the existential macroeconomic question of our time. If the autonomous machines are capable of doing the marginal work, giving massive tax cuts on human labor might be exactly like handing out tax subsidies for horse feed in 1910. It is a very nice gesture for the farmers in the short term, but the Model T is already rolling off the assembly line.
And if that's true, if the horses are already obsolete, then all of this massive fiscal stimulus is just propping up an economic model that is already the walking dead.
That is an incredibly heavy thought to end the week on.
Well, on that cheery existential note, thank you for listening to this deep dive. Keep your eyes glued to the 10-year yield, watch the wire for any news out of Geneva or the Gulf, and maybe, just maybe, don't rush out to spend that big tax refund just yet.
Definitely save it. Keep it liquid.
We will see you all next time.